Ticker symbol CME has been fairly stable for the past year as it has only returned around 9%. However, today we'll be looking at an established player with pricing power which yields a 5% dividend. Now, it has solid fundamentals and its efficiency ratios are fairly stable, and it operates in a sector that has low competition rates, but this company has extremely high recurring revenue rates. So today we'll be looking at CME Group, a financial services company. In their annual report, they state that they enable clients to trade futures, options, cash, and over-the-counter products, and allows clients to optimize their portfolios and analyze data. So CME Group is a company that offers benchmarks for different financial assets such as interest rates, equities, foreign exchange rates, agricultural commodities, energy, and metals, which basically allows companies, individuals, and investors to buy and sell these benchmarks as if it were a bet for example, interest rates increasing or decreasing. Now, they sell to all types of clients. They sell to financial institutions, they sell to investors, major corporations, manufacturers, producers, governments, and even central banks. Now, they mainly focus on options, which allows financial institutions to speculate and producers and manufacturers to actually hedge their bets. Now, they have a strategy which can be divided into 4 different pillars. The first one being to maximize futures and options growth globally. The second one is to diversify their business and their revenue, and they have already done this by acquiring Nex. This acquisition is great as it will allow them to offer more products and actually reach a lot more geographies than with the ones that they were already in. Now, number 3 is to deliver unparalleled customer efficiencies and operational excellence. For example, one thing that they have been focusing on is to manage clearing positions in an efficient manner to improve their customer experience. And finally is their partnership with Google Cloud, which took place in 2021 and is a 10-year contract. What they did here is to expand access to the CME Group's infrastructure, advancing real-time data capabilities, and many more, allowing their clients to access their data in a faster, more efficient, and safer way. Now, this company has extremely good financial metrics, except for the return on capital employed, which is only about 3%. However, since this is a financial services company and what it does is that it manages cash, their return on capital employed may not be the most appropriate metric to measure their operational efficiency. This is because their liabilities are actually inflated due to them actually holding the cash for their clients, whether for a normal company, this is not the case. However, when we move on, if we can see their interest coverage ratio is 21 times, which is above our threshold of 10 times, and then they have a very solid cash conversion of 100%, meaning that every dollar that they get of net income is converted into free cash flow, something extremely positive for the investor. Now, their profit margin is a solid 82% and their operating margin is ranging above 60%, which is incredible. This company has been growing their revenue and gross profit every single quarter since December 2021. However, we can see that their net margin actually contracted from June to September 2022. But no worries, it has started to grow since then again. So much that their net income has actually risen by 12% year over year. And when looking at their efficiency ratios, we can see that they are extremely stable, except due to the fact that they're all very biased as they have a lot of liability, a lot of equity, since they're managing a lot of cash, which inherently reduces these metrics such as return on capital employed, return on invested capital, and all similar. But when looking at their financial position, this is extremely great. Just look at how stable their current ratio has been in the past. This means that they're tracking this to the cent, as it has been ranging close to 1 for the past 9 years. Now we can see that their debt increased in 2020 and increased further in 2021 and now has started to decrease. This is an extremely good trend, and as we can see, their total assets are also decreasing, which inherently is increasing their return on capital employed and all those metrics as well. Now, when looking at the fundamental analysis, I have to say that this company gets the perfect 8 out of 8 ticks. As they have low liability risk, as we stated, they have very solid balance sheet, as of course they have positive equity, and the cash flows that they generate are extremely consistent. Now, this company yields a very juicy 5% dividend, which is great, especially for a company which has solid fundamentals. And of course, this company is able to grow their free cash flow organically. Why? Well, because they're able to grow their revenues organically, which means that they don't only rely on investing in other companies and acquiring other businesses to grow their top line. Now, finally, they have pricing power and they have a very solid competitive advantage. Why? Well, they have extremely high recurring revenue. It has a pretty steep learning curve, as you need to learn how their platform works, how you can actually purchase options, which strategies work best, how to speak with their commercials. So once you're actually using CME Groups, it is very likely that you will stay with them as long as your experience is okay. I believe that there are high switching costs from you actually switching from CME Group's platform to one of their competitors, which is not worth it. And since they're so focused on improving their customers' quality and their experience when using the platform and actually doing trades, and this is why they have such high recurring revenue rates, which to me is the best competitive advantage that can exist, because it basically means that you're doing your job so well that customers don't even want to consider other options. Additionally, they have pricing power as they are the owners of the platform and the software, and they can manage to increase their prices above inflation, especially when they're so focused in adding new products, as we have been able to see by their acquisition of Nex. And now, their dividend, as we can see, their dividend has not been extremely stable because at some points they have actually been paying a lot more than previous years. However, they are currently offering a very juicy 5% dividend yield. One thing that I do not like about this is their payout ratio. As you can see, their payout ratio is 111%, which means that it is higher than the money that they're actually making. This is a bit worrying, and it basically means that this dividend is very hard to actually be sustained. And one way to actually prove this is that we can see that their green charts, the amount paid, has been staying pretty flat. Now, when looking at their valuation, we can see that it currently is trading at the cheapest it has been trading in the past 4 years. And when looking at the free cash flow yield of 4.71%, we can see that it is trading at an attractive valuation as it is trading higher than the long-term inflation rate of 3%. Now, when looking at risk and possible challenges, I basically see, first of all, the performance, them not meeting performance objectives, especially with that 111% payout ratio, which I'm not a big fan of. And secondly, because this sector is sort of cyclical and it moves with economic downturns. Now we're in a period which has had extremely high uncertainty with the pandemic, now the wars, and this makes a lot of manufacturers and companies speculate and hedge against their bets in order to protect themselves. However, in the future, if everything becomes a lot more certain and there are a lot less geopolitical tensions, my bet is that they will lose some clients which will not need these products. Now, before we move on, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a strong competitive advantage and it does generate consistent, growing and predictable cash flows. However, it does not have a higher return on capital employed yet, but I believe that this is a good company and it will probably be a good investment. However, I believe that they have slow expected growth and that is keeping me in the sidelines for now. So thank you for watching. As always, this has been the Cashflow Compounder. Join the Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.